I think there are some opportunities to pick up some attractive stocks or maybe in the low risk credit segment as markets are kind of acting, at least over the last 1-2 weeks, a bit negatively around the new Omicron variant. But I think when we look at the economic data, in particular out of the US last week, I know we had a little bit of a miss on the payrolls, but if we look at the ISM services, they're basically suggesting at a 69 print that the US economy is running at its fastest pace on record here when we look at the ISM service sector. If we look at the manufacturing on top or the unemployment rate, we really have the world's largest economy growing very strongly. And the areas that we're looking to pick up some value is certainly around sectors such as energy. When it comes to countries, it's Europe or Japan, where we have not only kind of recovery into 2022 from the pandemic, but at the same time, central banks, the European Central Bank, the Bank of Japan, that are staying very easy, which is a bit of a different story from what we're seeing from the Fed these days.
Mark, where is the lower risk credit segment that you referred to in the early part of your answer? When I look at treasuries with a 1.38 handle as they were earlier this morning, and I look at the pricing of investment grade and other parts of the credit spectrum, I don't see anything that looks particularly good value, I'm afraid.
It doesn't at the moment. We certainly look in the lower risk segment. So basically, we'd say that default rates are likely to stay very low in this environment where corporate earnings are very strong. So in the US, it'd be more around the high yield. We currently have a neutral position. We certainly have a lot in our portfolios from more of a strategic asset allocation perspective. But if we were to see spreads widen, say another 100 basis points towards 450 basis points, I think we are looking at a risk case of Omicron, obviously, which is one where we have not only high transmissibility, but also high severity, high vaccine evasion. But even in that kind of case, we think that it would be a quote unquote speed bump in terms of the economic recovery that would be temporary, maybe lasting 6 to 9 months in the US, and which wouldn't really derail or see a significant pickup in default. So we're sort of waiting for markets to see what they're doing. This morning, things are obviously opening up more on the positive. Well, if we were to see kind of a more spillover, not only into equity, but also credit markets, we think there would be value, particularly in some of the developed market credits, potentially also in emerging markets. But there we would wait to see how exactly the virus variant of Omicron plays out there.